Hi, this is Kevin McPartland. We're going to talk about what happened in the Treasury market in October. Trading activity via both voice and chat and bilateral streams in October looked nearly identical to October of 2019. A surprise given that 2020 otherwise has been a year like no other. We're still of the mind that streaming activity will pick up over time, some directly between counterparties, but more through the platforms, as the complexity of managing the plumbing will eventually not prove worth it for many market participants. However, the disruption that is 2020 may have slowed some market participant efforts in that regard, despite what feels like an inevitable evolution forward. Overall, average daily volumes in October were down about 9% compared to last year, with the drop most reflected in central limit order book activity. RFQ trading, on the other hand, grew in the same period, both on a relative and absolute basis. The numbers would suggest that clients are trading more and more electronically, and dealers are increasingly hedging their risk via internalization, which means trading between internal desks or between internal legal entities and the derivatives market, rather than hedging via central limit order books. Taking a look at the derivatives market, while the U.S. Treasury futures volume declined on a volume-weighted basis from the previous month and from October of last year, Treasury futures showed their first return to near normal trading levels relative to the cash markets. In other words, U.S. Treasury futures volumes equated to 61% of cash market volume in October, more in line with historical norms. It was 68% last October, and well above the roughly 40% levels the market has seen for non-roll months since March. No doubt pre-election market uncertainty played into the activity, with 1 month yield volatility as measured by the MOVE index rising in October as well. To that point, however, volatility in October was still almost 30% lower than it was last year. A reminder of how stabilizing Fed intervention can be despite an otherwise uncertain world. Lastly, we can't not talk about LIBOR. SOFR futures also saw a boost in volumes and open interest in October as the major clearinghouses, CME and LCH primarily, made the transition from Fed funds to SOFR discounting, a major step in the move away from LIBOR. SOFR futures volume at CME hit a record averaging 56,000 contracts a day, although open interest remains below its peak in March. On a related note, October saw volumes and open interest in Eurodollar futures continue what has been a slow but steady decline given the role as a LIBOR hedging tool. Nevertheless, Eurodollar futures trading still dwarfs SOFR activity by a wide margin, with 1.2 million contracts traded daily during the month. Thanks so much for listening. Come back next month. This market keeps evolving more than ever, and we look forward to talking to you then. Thanks so much.